Thank you, James. I'll just share my screen. Give me a second. There we go. Come to full screen. Okay, shall we get Simon in? Are you there, Simon?
Yeah, I am, Richard. Good morning.
Hi, how are you doing?
I'm very well. Thanks for having me on this morning.
No worries, no worries. I'm really looking forward to hearing from you. So we've got your sort of bio up there. It said fund manager of Life Science REIT, which you launched, was it October or November last year?
That's correct. Yeah, we IPO'd on the 19th of November. If you want to flip forward.
Just the disclaimers.
There we go. Yeah, so we IPO'd on AIM on the 19th of November last year. We were oversubscribed. We raised 350 million of equity. We're an externally managed REIT targeting a total return of 10% per annum. So a combination of income and capital growth with a sort of what I would call classic sort of REIT capital structure of about 1/3 debt, 2/3 equity.
Okay. Cool. So yeah, as we normally do with all our guests, give you sort of five minutes or so just to sort of introduce the fund, what you do, what you're about and stuff, and then we'll take questions.
Perfect. I've got quite a few slides, so I'll whiz through, but if you could flip forward, that would be great. The premise of the fund is to acquire assets in key life science locations around the UK, and then give those assets what we call sort of TLC, working our business plans to really work up the income and to reposition them where required into life science use. And I really want to just talk a little bit about that first off, because if you could flip forward through the timeline there into the life science slide, that would be great. There we go. Because this is a sector that's well established in the US. I mean, Alexandria REIT has been one of the top performing REITs in the US market now for several decades. But we are the only dedicated life science vehicle in the UK listed market. And I think it's important just to perhaps put a bit of a context around what is life sciences and why it's so relevant. I mean, we've seen an unprecedented level of innovation and investment in the life science sector in the UK and medical technology over the last few years. And every day you're reading about new innovations, trends towards personalization of medicine, and this morphing of the biology and the technology. So we have very strong structural tailwinds and demographic changes and scientific advances, which are supporting the life science sector globally. And the UK is, without a doubt, punching well above its weight. We are a real market leader, both in research and production in life sciences. And this is really being driven again by growth and development through research in biotech, pharmaceuticals, nutrition, medical technology. All of this, or the vast majority of it, is focused around the major universities and hospitals, particularly in the UK, these key clusters and centres of research and innovation. And we call it the Golden Triangle in the UK. It's Oxford with Oxford University and the John Ratcliffe. It's Cambridge with Adam Brooks and Cambridge University. And it's London with UCL, UCH and Imperial College. We have 4 of the top 10 universities in the world for medicine and life science. And I think it's something that's probably a little bit underplayed in the UK, but the government and the private markets certainly picked up on it. And all this is backed now by a powerful combination of government and private sector capital. If you'd like to flip forward. The life science ecosystem, we call it sort of the triple helix, if you like. This is the cluster theory. This is the triangulation of the academia, the research, and the capital. And you know, life science is a broad church of uses. It's a broad church of activities. It's everything that touches human health, from prevention, so things like agri-tech, creating a more healthy and better production of food, for instance, in the UK. All the way through to the sort of gene therapy research, the vaccines, the DNA research that you're seeing coming out nearly every day in the press. And within all of that now is this morphing, as I said before, between tech and the biology. if you look at DeepMind, which spun out of UCL, is now owned by Google. They are a tech company specializing in artificial intelligence, but they are at the forefront of what's happening in the fight against cancer, Alzheimer's, and various other what we call structural diseases in the UK, including diabetes. So, this is a rapidly changing and really exciting sector. Flip forward, thank you. I talked about this sort of cluster theory, and I think there's to put it in sort of real life example. I don't think there's a better example in Europe than what's happening in what we call the knowledge quarter around St Pancras, King's Cross in London. UCL and UCH have been established there for many years, along with the Wellcome Trust. You've now got Google, DeepMind, with their new nearly 1 million square foot HQ being built just behind King's Cross Station. You've got the Alan Turing Institute, the Francis Crick, which is 1 million square feet of absolutely mind-blowing science. I mean, we were fortunate enough to have a tour of the Francis Crick. It is quite staggering what's going on there. They've just raised another £1 billion funding from their various backers to fund their next level of research. Moorfields Eye Hospital are relocating from East London into the cluster as well. Syncona and Merck, the US pharmaceutical company, have announced their new European research HQ at a cost of £1 billion, which is again being just started right opposite King's Cross Station. So this is a real example of how the academia, the private sector, the medical research all comes together in this sort of cluster theory that we talk about. Next slide, please.
Oh, don't know what happened.
Talk about the different types of real estate, because it's really important to sort of, every occupier has a slightly different business model, if you like, and within the real estate there are various key components. So we have what we call traditional offices, which scientists like to call write-up space. We have wet labs, which is your traditional sort of Bunsen burners and test tubes. We have dry labs, which is very high IT usage, so computer labs for AI and for data. We have data centers, and we have production. I think one of the key things that's come out over the last few years, particularly post-Brexit and now post-COVID, is countries and organizations being more secure in their supply chains, and actually the reshoring of a lot of production of both R&D, medicines and technology is a big theme, especially within life sciences, where governments particularly are keen to protect their country's resources. So all of these types of uses fall within what we call the life science real estate sector. They're often in these key clusters around these hubs, but you can have companies that have all of these 5 uses under one roof, and we do have that within our portfolio. So you have to create flexible space in the right location for the modern life science occupier. Next slide, please, Richard. I talked about the UK. I mean, why the UK? We are number 1 in the world for medicine. We have 3 of the top 4 universities now, 4 of the top 10. We have more graduates in science, maths, and stats than any country in the world, and we attract a huge amount of overseas investment into our medical resources in the UK, both public and private sector. Talk about the how this feeds through, if you like, into the economy. In the 4 quarters to the middle of this year, the Golden Triangle, which is Oxford, Cambridge and London, accounted for over 80% of total funding into UK life sciences, nearly £6.5 billion. I mean, to give you some real life examples, Oxford Science Enterprise, which is the university's own investment fund, raised another 250 million from investors to invest into life sciences, spin out businesses from the university, and we'll come on to that in a minute because that has a big impact on our portfolio. Big investors in that are Alphabet, Temasek, large family offices like the Bill and Melinda Gates Foundation. So what you're seeing is you're seeing a sector which is really, really well backed by different capital sources. And I think one of the key things to bear in mind is this isn't a sector that's particularly vulnerable to the economic cycle. I mean, it's not dependent on consumer spending or house prices, and the sources of capital are incredibly varied. You've got big tech, big pharma, government, private equity, family offices, private institutions. So it really is a sort of, if you like, almost a counter-cyclical play in terms of the occupational markets. Very briefly, I talked about Oxford. I mean, phenomenally successful in backing spin-outs from the university with its own money and with its own enterprise fund. As I say, that fund now has put over 800 million into spin-outs from the university, and that's really accelerated over the last few years. And this feeds right through into the real estate markets. There's a chronic shortage of high-quality space in the Oxford market for occupiers, and again, that's feeding through now into levels of rental growth. It's feeding through into some of the cap rates that we're seeing in the market. And when we come onto our assets, you'll see the levels of activity and the levels of interest in the sort of space that we're offering to occupiers is steadily increasing. And Cambridge, a slightly different model. Cambridge has been very successful as a city in attracting major corporates. So AstraZeneca relocating from the Cheshire Plains down to Cambridge. You've got Microsoft, you've got Apple, you've got Wellcome, Genome Park. A slightly more sort of different, varied, if you like, growth story from Oxford, but with the similar result. I mean, there is currently zero fitted lab availability in Cambridge, with over 1 million square feet of potential requirements. And again, this is feeding through into sort of levels of rental growth that we're seeing in the market, and demand from occupiers for space. And again, we'll come on to that when we look at our portfolio. So we had a pipeline of assets that we pre-IPO that we had under offer and under exclusivity, and I'm delighted to report that we closed on all of those assets in our pipeline, the vast majority of them between IPO in mid-November and the year end at December. We then closed on the final asset there, Oxford Technology Park, which is our Oxford flagship, in early May. So that gives us an overall portfolio of just over 400 million by the latest CBRE valuation at the 30th of June, with a healthy split between the 3 points of the Golden Triangle, and a healthy split again between what we call hybrid and lab space and offices. Hybrid and labs is really space that can be used for any combination of the uses that I talked about before. So it can be offices, it can be production, it can be wet labs, dry labs. So we're delighted with the portfolio. We're exactly where we want to be in terms of positioning. We've got the right sort of assets that are all suitable for life science occupiers. And I think key in the current environment, and I think the first question that a lot of REIT managers are being asked at the moment is the sort of financing structure. As I said, we have a dual facility with HSBC at 75% term loan and at 75% RCF. We're, as of the 30th of September, so an update from our mid-year results, we're fully drawn on the term loan. We also have a development loan that we took on board when we bought the technology park at Oxford. We're in the process of refinancing that loan at the moment. We're in discussions with our banks. And we've also put a cap in place on the RCF and on the development loan. So we're 95% hedged on our current debt. We have good levels of liquidity available, both cash and undrawn RCF. And we have a gross LTV there of just over 25%. Our sort of, target, if you like, is 30 to 40%. And our net LTV at the moment is in the low teens. So we're very comfortable with our levels of debt. As I say, we have actually repaid part of the RCF that we had drawn recently, and we are in discussions with our advisors again on just hedging out that last small part of the drawn debt.
Cool. Is that the end of your?
Yeah, we've got case studies, but I'm very happy to, I'm conscious of time, and there's quite a lot of info there, so I'm very happy to straight to Q&A if that suits.